Welcome back. Two more segments to go for Module 11, and we'll finish off the cash flow statement gracefully. Let's take a look at about some analysis, what we're trying to understand, what we're trying to do. So we want to use these statements to make decisions, to help us understand what's going on with the company. Now, remember, financial statements are historical records. They're indicators of what happened in the past. And we do try to make some future decisions based on the past performance. And we can make some pretty good ones. So let's take a look at the components. So most established companies, once we've been in business for a while, have a positive cash flow. Early stages, you're losing money. You're attracting investors, but you're having positive cash flow from investment, but you have negative cash flow because you're buying equipment, paying for things, and you have negative cash flow because you're running losses. You don't have many profits that you're connecting with that is going to generate that positive cash flow. As a matter of fact, in the initial stages, it's all expenses, zero revenues. And you start making something that you can sell, you start getting some revenues, but your expenses still exceed the revenues, and you're writing checks for those expenses, and you're getting checks for those revenues, but they're not catching up yet. But eventually, as I say here, when you get more established, you better have positive cash flow. Operating cash flow provides most, if not all, the total cash required. So operations is the best indicator of future performance. You can track investors sometimes. You can also buy equipment and sell equipment sometimes. But the normal routine revenues and expenses, the current assets and current liabilities, that's your bread and butter of the business you do. On average, investing cash flow is typically negative as companies grow to support the business. So they're spending money, they're investing in equipment, in plant and facilities, and even some intangible assets. And then financing kind of makes up the difference between operating and cash from investing. And again, in the early stages, you're attracting lots of money, hopefully, as an equity investment or as debt. And eventually you're paying it off, and that can kind of go up and down. You may buy back treasury stock and use cash, or you may sell treasury stock or issue some more shares and get some cash. So there's a life cycle here. You've probably seen the product life cycle from a marketing perspective: introductory phase, growth phase, maturity, and decline. So what happens? Revenue starts at zero, and different product lines eventually reach maturity. Net income starts negative. We're running losses early in the game. Then we grow, and hopefully we'll start making a bunch of money. And then we have a decline until it's no longer profitable for whatever particular product we are selling or using. And then finally, the cash flows overall. This is what we focus on. Right? We're looking at operating in the green. So early stages, negative, and this gets profitable. Investing early stages is also negative. We're spending money. And there's a crossover at some point. We start reducing the property, plant, equipment, either sell off the assets or use them up. And financing starts out higher. That kind of makes up for the difference early stages. Financing covers the costs of investing and our losses for the initial stages until we grow. But eventually financing will go to a negative cash flow as a statement as well. First we have it coming in, then we have it going out. We'll pay dividends, that's going out, and stock will be changing accordingly as well. So here's the patterns that go with that. So Lowe's. Now, Lowe's has lots of different products. When we look at the product life cycle, we're saying, okay, that's one product line, that's one operation, that's one company. But a company that acquires more companies or that has different product lines is going to have multiple sets of these at different time frames. So hopefully, ultimately, operations is the positive cash flow. And here it is, cash from operations in the green. That's for Lowe's. And it's a slight upward tilt, which is actually a positive. And then we look at our red, which is investing. And we predicted that. We said, you know what? Yep, we got cash flow from investing. Then we were down some. Then negative cash flow actually increased more negative, but we're coming back. And yep, it's always below. It's always been a use here at Lowe's. And when they're expanding as quick as they are, that actually makes some sense. And then financing, we also have negative cash flows in billions associated with financing. But we are taking care of that. We're a mature company, So we're getting a lot of our cash flow, most of our cash flow positive, all of it's positive that's coming from operations. Here's Southwest, similar idea, rising operations, but here both the investing and the financing are decreasing. Purple is the financing, the red is the investing. And we have increased positive cash flow. We have increased negative cash flow from these items, from investing and financing. So we have our outlay of investing and financing, we have negative cash flows associated. And then we have Tesla. Tesla's an interesting case. I think I've told you before, they went for 17 years without a profit. And you look over here, yeah, actually, that looks pretty good. At this point in time, they were still running without a profit. And then they started generating positive cash flows. We have our purple, cash from financing. That's how they survive. They have all these investors willing to put money into Tesla. Oh, electric vehicles, cool. That's the future. 14, 15, 16, 17 fiscal years. All right, now getting later on, yeah, we're maxing out our investments. We're attracting, selling stock off, attracting or issuing debt. And then we have the cash for investing. So we still had to buy plants. We have new lines, new products. And I think this was probably when the Model 3 was being introduced. So they had to have major expenditures in manufacturing that they had to cover. And then they're starting to recoup that as well now later on at 18, 19. So a reduction in the spending. One more slide to go. Let's talk about the usefulness overall. We're going to start with financial flexibility. Can the company generate enough cash for not only needs that are unanticipated, but opportunities we want to take advantage of? Because we're going to need cash. If we have a company that we can buy, we may need the cash. Information about past cash flows, particularly operating, helps assess this flexibility. How much of a cushion, how much can we take advantage of if opportunities avail themselves. Then we look at quality of earnings. Net income involves many adjustments that can introduce subjectivity. So we might have net income because we sold off some equipment, not from operations, or that we happen to be lucky and the tax laws change and we have some benefits associated. Some users prefer a more objective performance measure. Cash flow from operations is over income ratio. That is actually a sign of the quality of earnings. We'll see that in the next set of slides. And then we have sources of cash flow. Changes in cash is less important than where the cash is coming from. So the statement of cash flows can enable analysis on the specifics of the sources and uses of cash. So that's given you a taste and a flavor of some of the interpretations and the analysis. The next set of slides, the last element of Module 11 that we're going to cover, will actually calculate some of these ratios. And yep, those are going to be ones we get to memorize and use and apply. So thank you for your indulgence, and I look forward to seeing you again very shortly. Talk to you soon.